Hello there. I'm just going to wait a few more moments just for a few more people to jump on, and then we will kick. Okay, thank you very much for joining me. I'm Fiona Cincotta, Senior Market Analyst here at City Index, and we will be going through the economic calendar, looking at the week ahead. What are the major events that are likely to move the markets, and which markets they are likely to move, and any potential trade setups that we may be able to see in those potential markets as well. So just before we get going though, as always, just need to ask you to read through the risk warning. If you could just take a few moments, I'm going to mute myself whilst you read through that. Excellent. So let's kick off, as we always do, by taking a look at the economic calendar and having a peek at what we've got in the coming week. Now, normally, so this is the economic calendar on our website, and as always, filtered for next week and for high impacting events. Now, usually, as you know, I walk through this going through day by day as to what's happening, but we've got such an action-packed week next week. There are so many major central banks announcing their interest rate decisions next week that I thought actually we're going to take a slightly different approach and work through the central banks through the order in which I think could be the most important and the most relevant, and we'll go from there. So actually what we're going to do is, first up, we're going to jump to the FOMC. So this is the Federal Reserve interest rate decision, which is due on Wednesday, the 20th of March at 6 p.m. GMT. The Federal Reserve are widely expected to leave interest rates on hold. So what's going to be the main focus? I mean, if we think about where we are as we come into this event, we've had a lot of data out of this week as far as the US is concerned. We've had hotter than expected consumer price inflation. We've also had hotter than expected producer prices. So basically, what's this telling us? This is telling us that inflation in the US isn't cooling right now. Now, what we don't know is whether this is just a blip in the road of a downward trend, or whether this is actually the start of a more ominous increase in inflation. I think the other thing that's clear is that the Federal Reserve does have more work to do to bring inflation back towards the 2% target rate. Now, the Fed is not expected to cut interest rates in the March meeting. In fact, it's been fully priced in that the Fed will leave interest rates on hold at their current levels of 5.25 to 5.5%. Now, as we've seen, these signs of sticky inflation, this means that we have seen expectations for the June interest rate decision change a little bit. And so this is what's going to be the big focus for the market. Is not actually, you know, are we expecting a rate cut? No, we're not expecting a rate cut. So the focus is going to be very much on the Federal Reserve's dot plot and any hints, tips, clues as to when the Fed may start to cut interest rates for the first time, and also how many cuts are we going to be expecting across the rest of the year. Now, if we just look at the chart that I've got on screen here, this is the CME FedWatch tool, basically just showing us that expectations for a June rate cut are down to 60% basically probability. Now that's been reduced from about 80% just a month earlier. Okay, so we've seen, you know, a fairly big reduction in expectations there. What's interesting here is, although inflation is ticking up, although the jobs market is relatively resilient, and you know, growth remains steady, the market is still pretty firm on expectations that they expect to see a June interest rate cut. I think there is a chance that the Federal Reserve could err on the side of caution in this meeting, so we could start to hear a slightly more hawkish Fed than perhaps what we've heard at previous meetings. Now, this is the dot plot from the December meeting, and the projections we're going to get again in this meeting, and they're going to be a massive focus. Okay, so I mean, the market in December, the Fed indicated it was looking to cut interest rates 3 times this year. There's a chance, I think, that we could see that reduced given the stickier than expected inflation. We could see that the Fed is actually not looking to cut rates 3 times this year anymore, potentially just 2. So I think all in all, what we perhaps might be looking for is, you know, as we head into this meeting, we know that the market's been absolutely fixated by when the Fed's going to start its rate cutting cycle. And I think, to be honest, we're unlikely to get much clarity next week over when that might be, given the fact that inflation is ticking higher. The Fed is most likely going to stick to this view that it will remain data dependent, and, you know, it will be guided by the path of inflation. I think there is a chance as well that we could see the dot plot showing one fewer rate cuts this year. Now, what would that mean for the market? So let's just now jump back over to our charts. Let me pick up the dollar. Okay, so firstly, if we do start to hear a slightly more hawkish sounding Federal Reserve, that's going to be played out in the US dollar, where we could expect to see perhaps a stronger US dollar. We've seen this pick up from the March low, where the price dropped to 102.35. We've seen a rise above this resistance here at the 103 level. This has all happened, you know, basically this chart, this bar here was that hot inflation, PPI data yesterday. And that's really seemed to have, you know, coming after the stickier consumer inflation data. It's yesterday's data really seemed to sort of ride home the idea that inflation is proving to be sticky. Now, if we sort of see a continuation or an extension of this rise higher, I think the line of resistance that we'll be looking at here is 103.65. That's the 200 SMA. Buyers are going to be looking to get over that level in order to gain momentum, you know, and head back towards 104 and the 105 2024 high. If we do find that the Federal Reserve actually stay put with everything, keep those 3 rate hikes still planned for this year, don't really give away too much else, then, you know, we might find that in that case the US dollar would come under pressure again, potentially, as the market sort of continues to expect those 3 rate cuts this year, and that would see this level tested here around the 103, a break below that bringing the 102, and then the 102.35 level and the 102 here into play. So just whilst we're looking at the US dollar, why not let's also have a look at gold, which obviously has been massively in the focus this over the past week or so, after hitting that fresh all-time high last Friday at 21.95. Now, we have actually seen that gold has eased off It's just consolidating around that 2165 level. We're seeing that that's just putting the RSI, which is trying to come back out of overbought territory. I mean, gold trades within this rising trend, within this rising channel. You know, it's been supported higher by the 20 SMA there. You know, what's going to be looking here if sort of after a period of consolidation, if we do find that the Federal Reserve adopts a more hawkish tone next week, that could actually have the impact of bringing gold prices lower, quite simply because a slightly more hawkish Fed, less chances of as many rate cuts this year, is not good news for non-yielding gold. Also, if it does cause a strengthen in the dollar, US dollar denominated gold, then it's likely to come under pressure as well. That's going to leave this level here. It's going to bring very much this level here in focus. That's at 2146. That was the previous all-time high from the end of 2023. Pretty key level there. If we're going to see a breakthrough there, then that's going to bring, there's quite a large jump down. I guess there's 2100, but that brings then this level here, which is the December high at 2089, 2090, that sort of level into focus. On the other side of things, if we're finding that the Federal Reserve is not as concerned about the sticky inflation as we might expect them to be, then we could find that the buyers are going to look for this level here. This is the 2200. It's, you know, just above that 2195. Obviously the all-time high if we get a break above there, and this 2200 is the next level in focus. Or also the upper band of the rising channel. Beyond here, look for 2500. And let's also have a look at what's going on with the Dow Jones. Wow, look at that. I mean, it was a really impressive rally, wasn't it, across the end of the final quarter of 2023. But if we just have a look here, we've seen that since the all-time high, which was reached in February, actually, did we reach it again the other day? No, we didn't, did we? We were just shy. So the all-time high of 39284 reached at the end of February still remains that record high. Since then, we've seen this, you know, it's been trading in a holding pattern, capped on the upside by that all-time high. On the downside, we're getting a capping there. We're finding some support around the 38,500 level. What's interesting here is we've seen this sort of the RSI is coming down quite considerably. So, you know, it does suggest that there is losing of momentum there. You know, breakout traders, what we'll be watching for here. Sellers, if we're getting sort of said a more hawkish sounding Federal Reserve, then we're going to be looking, sellers are going to be looking for a break below 38,500. That's going to create a lower low, and that's going to bring this 38,000 level, which is also the February low, into focus. Again, if we do hear perhaps the Fed is not as concerned, as I said, about that sticky inflation, or the market doesn't pick up on a concern as much, then we will be looking for a breakout above the 39,285 level to head to 40,000, the psychological level. So that is the Federal Reserve. Next one to be watching is the Bank of Japan. Now, the Bank of Japan, not usually one of the most exciting central bank meetings. In fact, quite the reverse. You know, there isn't usually that much to report on the Bank of Japan's interest rate decisions, but that could change this month. You know, we've had some hints and tips from the Bank of Japan for, well, since the end of last year, since this level here. You know, we had some, sorry, towards the end of 2023, we had some sort of suggestions that the Bank of Japan may consider moving away from negative interest rates. And then obviously the Bank of Japan was saying, no, it's too soon. You know, we've had really mixed messages from the Bank of Japan. But what they have said is that in order for the Bank of Japan to move away from negative interest rates, a precondition for a rate hike was a virtuous wage price cycle. Now, this is interesting because we've just had the results to the spring wage negotiations in Japan and Rengo, which is Japan's largest trade union, it represents over 7 million workers. Now, they amended their or they announced, sorry, so a wage increase of 5.28%, which is the largest in 3 decades. Now, this has been a very similar moves that we've seen from other major Japanese companies as well, who have agreed hefty wage hikes with their workers, again in sort of line with the largest in 30 years. So this means that we're starting to see those conditions align for the Bank of Japan to move away from these negative interest rates and to hike rates. Now, also just adding into this, we've also seen that inflation in Japan is over 2% now for over a year, and also their GDP was upwardly revised, so they have narrowly avoided a recession. So these are things just to keep in mind. But what's interesting is actually the way that the Japanese yen has reacted today. So despite the data about, you know, or this week, the data trickling in about the wage negotiations, the yen hasn't actually been strengthening. Now, we know that the US dollar has been strengthening, so that's obviously been the dominant force, but you know, the yen hasn't put up that much resistance, which makes me sort of wonder whether the market isn't necessarily expecting a move in March by the Bank of Japan, and then maybe they'll just push that out to April. But I mean, we're at a fairly key junction on the chart. We're coming here to test the 148.80, which is the high from the January high. This is after the price rebounded nicely off this falling trend line support and also the 200 SMA. So, I mean, what we'll be looking here is how traders react to this 148.80 level. If we get a rise above that, then that really does bring in the 150.90 level, which is the 2024 high. If we get some rejection, if the price faces rejection there is, you know, as far as support is concerned, be looking down here at around 146.30, which is the 200 SMA, and it's also the last week's low and the March low as well. So that's a level to keep in mind. Below that, we've got the 145 level here to watch out for. So yes, that'll be an interesting one. Also, let's just keep going with these central banks because they're just not stopping next week. So as I mentioned, we've got the Fed, we've got the Bank of Japan, and we've also got the Bank of England. Now, the Bank of England is not expected to cut interest rates. We've also got, interesting to note, before the Bank of England, who will report on Thursday, their interest rate decision. Sorry, I didn't mention Bank of Japan's on Tuesday. So yeah, so this is on Thursday now. This is why we're jumping about, but it makes it a little bit more difficult to keep up. But so yeah, Bank of England Thursday, no rate cut expected. So we're expected to see interest rates remain at a 15-year high of 5.25%. Before the Bank of England rate decision, we do also have the UK inflation data. Now that is expected to show that inflation has cooled again. Well, it remained sticky last month actually, didn't it? So I don't know why I was saying cooled again, but it's expected to cool to 3.6%, down from 4%. Still very elevated though, you know, if we think about in comparison to the Eurozone, where it's down around 2.5%. So, you know, it's still sticky inflation, still well above the Bank of England's 2.2% target. But there are some sort of signs that we've seen this week which might sort of start helping the Bank of England relax a little bit. We've seen that there is a slight slowing in the UK labour market. We've seen wage growth slow to a 2-year low. We saw vacancies fall as well for a 20th straight month. We saw unemployment tick higher. GDP remains out of negative territory, but still 0.2% growth, nothing to get too excited about. You know, still very, very lackluster. Also, interestingly, inflation expectations out today showed that inflation expectations over the next 12 months fell to 3%, down from 3.3%, which is also the lowest level they've been for 2 years. Now, I think about what we might expect from the Bank of England. I mean, let's not get too excited. I don't think they're really going to be giving any strong hints about when they might start cutting interest rates. I think we're still quite away from there. I mean, if we think the first rate cut from the Bank of England is expected in August, that said, bets for a June rate cut have increased this week after the data that we've seen, but still the major expectation is for an August rate cut. There is a possibility that we could get another 3-way split. If we think about what happened at the last Bank of England meeting, we had some majority of policymakers vote for a hold, though there was 1 voting for a cut and 2 for a hike. So I think there is a potential for a repeat scenario. So let's just have a look at what that means for the pound and how the pound has been responding recently. So this is the pound against the US dollar. Now, I think the pound against the real US dollar has actually remained pretty well supported. And that's just basically on that simple expectation that the Federal Reserve was expected or is expected to start cutting interest rates ahead of the Bank of England. They're expected to start cutting interest rates in June, and the Bank of England not until August. And so that has kept the pound supported and even rising to the 7-month high that we saw at the end of last week. However, this week we've actually seen the pound come off because I think we've seen, you know, a mixture of the market just reining in those August rate cut bets to potentially a June rate cut, and also at the same time the pushing out of the Federal Reserve rate cut as well. So as a result, that means GBP USD has come under pressure across the week. It's fallen below the December high that we had marked in there at the one at 28.30. It's heading, I would say, towards the next level of support here, which is 127, which is the 20 SMA. It's also the February high. If we get a breakthrough there, then that's going to expose the 200 SMA at the 125.85 level. On the upside, if we do see any sort of recovery here, then buyers are going to be looking to get over the 128.30 level, which was also, no, it wasn't. I was going to say it was the weekly high, but it wasn't at all. So, but in order to get back towards the 129 focus. Okay, so that's, whilst we're just talking about the Bank of England, let's just have a quick look at what's going on with the FTSE. I might just need to update the chart slightly here. Let's have a look now, you see. So this has been interesting, the FTSE. It has had some sort of signs of recovery. It picked up off this 76 level. This is after the data came out that suggested that the UK economy had moved out of a recession, or the recession in the UK could be short-lived. I mean, the March high 77.85 didn't break meaningfully, couldn't break above that, which means the 78 level, which is the high from May last year, remains a key resistance. I mean, broadly speaking, it does look as if this could continue to push higher. You know, we're still above the 200 SMA. There is the 20 SMA guiding it higher. But as on the downside, I was going to say that would be a level to watch. The 77 round number, that could be a support level. Breakthrough there is going to bring 76. This is a pretty key level here. If we get a breakthrough there, it exposes the 200 SMA at the 75.47 mark ahead of the rising trend line. Okay, so just moving on, we've got the RBA. I said there are loads of central banks next week. I wasn't joking. So now the RBA, they're expected to maintain interest rates at 4.35% for a third straight meeting. And the market is very much expecting the first rate cut from the RBA to come in June. So if we do get any hints or suggestions that sort of either push back or bring forward that expectation, that's what's going to be moving the US dollar. There is a sense that we might get a slightly hawkish sort of tone from the RBI, given that inflation remains elevated. And if we did get a hawkish sounding RBI, then that could put the Aussie dollar in good stead against the US dollar. Again, obviously that would depend very much on what the Fed is saying as well. The RBA meeting is also on Tuesday, keep that in mind. But just to look here, we're testing here the 200 SMA. It just sort of tested that level today around the 65.60. And that's going to be a pretty key level to watch as we go into next week. If we do get a break through there because of US dollar strength or a more dovish sounding RBA, then 65.30 could be a level to watch. It's not only the falling trend line. Now this is a trend line that goes back right to the beginning of last year. So that's going to be something to watch there. And if we get a breakthrough there, then, you know, watch out for 64.80, I guess, as a level ahead of 64.50. On the upside, if we find that 200 SMA holds, then let's just be careful for resistance. The February high, which was 65.95, so almost 66 basically, with a move above there, sort of bringing in this level here around the 66.25, but ultimately 66.65, which is the March high before 67. So we've just got, I'm just going to squeeze in a couple more charts because that's all the central banks, but there is also other data. I mean, we've got Chinese retail sales and industrial production on Monday. We've also got, there we go, we've also got at the end, we've got Canadian inflation data. We've also got the Swiss National Bank monetary policy decision, and also we've got PMI data at the end of next week, so on the Thursday. As far as the Eurozone, I'm just going to touch on the Eurozone because we've not spoken about the Euro or the Eurozone today, but look, if we have a look here, we're expecting to see the composite PMI improve, but remain below the 50 level, which separates contraction, expansion from contraction. We're seeing, you know, manufacturing, a slow improvement. That's the thing that's really holding things back at the moment. Services are expected to push higher. Germany, the Eurozone's largest economy, again, services are expected to contract at a slower pace. Manufacturing is still desperately in a state of deep contraction there, and the composite PMI, which is the business gauge, is expected to contract again at a slower pace. Let's just have a very quick look here at the Euro US dollar, what's going on. So look, this is the rising trend line that we've seen in play since the mid-February. And following that stickier than expected inflation reading from the US dollar yesterday, you can see that bearish engulfing candle there. It's just breaking below that rising trend line support. It's bringing in, that's going to be, yeah, it's fallen down below the 109 resistance as well. So it's exposing the 200 SMA there at 108.35. That's going to be the next level to watch on the downside. If buyers can get back above the 109 level, that could be an encouraging sign for a move towards 109.80, which was the March high, as we head back towards the 110 level. And just finally, let's end with the DAX. It's me trying to work quickly now. Bear with me. I know time's running out. Okay, so just a final look at the DAX, because look at the DAX. I mean, this is trading around those all-time highs. So this is really interesting, despite the Eurozone economy looking to be in still a relatively sluggish situation. Definitely not, I mean, the outlook is improving slightly, but not particularly. We've still got that all-time highs, and that's basically on expectations that the Fed and the ECB will start cutting interest rates soon. You know, again, we've got the RSI here, very overbought, so potentially a period of consolidation. We've got a short-term rising trend line there, which would be sort of what to be watching, the break below in order to bring this level here. I think, you know, we're still constructive as long as it remains above 17,600. A break below there opens to 17,000. Buyers looking for a break above the 18,044 record high from yesterday in order to look higher. So that is everything from me. I hope you've enjoyed what you've been watching. If you do have any questions, then please do reach out to me. Otherwise, I will see you next week.